If you have a pension that offers both a lump sum option or a lifetime payout option, you're probably wondering what you should do. In this video, we're going to look at a case study on the whiteboard that shows the impact of taking a lump sum versus the lifetime income option. And our goal for it is to help you make your own personalized decision as you plan for retirement. So if you're struggling with this question, you're not alone. I will say many clients struggle with it, both DIY investors that are anti getting financial advice, and then for clients that work with financial advisors, practicing financial advisors, oftentimes it leads to bad financial advice from those advisors. And I think there are conflicts in every industry, but certainly this is an area where there are certainly conflicts of interest. So on one hand, you have advisors that may charge a percentage of the assets that they're managing for you. This is oftentimes resulting in a conflict of interest on that particular piece of advice. I'm not saying it's a blanket across the board, but sometimes if, let's say, there's some metrics that the advisor needs to hit, maybe it's asset growth or maybe it's a certain revenue target, and they see $500,000 sitting in a pension that could either be rolled over into an IRA that they're managing for you or turned into a lifetime income option. I see that as a potential conflict that advisors are struggling with. Maybe they earn commissions. Maybe they're incentivized to sell you private insurance products like annuities or life insurance. There also could be some conflicts there as well. So I see a lot of bad advice out there as a result of this. And as also, furthermore, DIY investors who are doing their own financial planning, I see them oftentimes making bad decisions because they're so anti-financial advice. And so this is why I'm doing this video. I want to talk about the pros and cons of these decisions. And I actually want to walk through, the results or the impacts of both decisions on this particular client case. In this case, we're talking about Jack and Barbara. Okay, so why don't we dive into just some high-level facts about this case. I'm not doing a deep dive into in terms of like a real true whiteboard retirement plan, which we oftentimes do with the podcast. But in this particular scenario, we're going to talk about the facts of the pension, okay? And we're going to talk about the impacts on rate of withdrawal, the investment portfolio, the Monte Carlo analysis, and ultimately the result in terms of ending legacy that would be left to the next generation. So Barbara has $346,000 in a pension, and she can either roll it into an IRA or she can essentially turn it into an annuity. And by the way, this is what a pension is. A pension is essentially it's an annuity that is not sold directly by an insurance company, but is offered by an employer. Sometimes it could be a private employer. Sometimes it might be a public employer like the federal government or a state government. But ultimately, it's what you're doing when you turn it into a life income stream is you're essentially annuitizing that account. And some pensions don't even have the option here. So some pensions you must annuitize it or it's automatically going to turn into an annuity. But in this scenario, there is a decision of, hey, should she roll it into an IRA or should she turn it into a life annuity? Okay. Simplicity purposes, there are several survivor benefit options. So there are several payout options if she were to choose the annuity. She can do single. Okay, so meaning it will pay her as long as she's living, but if she passes away, there's no benefit to her spouse, Jack. Okay, so single's not the ideal option here. She does want to provide some sort of survivor payment to Jack if she were to predecease him. So we're going to go ahead and cross that off. After that, there are other options too. There could be a 25% to survivor. There could be 100%. Or 75% or 50%. In this scenario, for simplicity purposes, we're going to choose that 50% survivor option, meaning whatever that monthly payment is to her will also continue to Jack in the amount of 50% of that value. So in this scenario, what you're doing is you're kind of buying life insurance on that annuity plan. Okay. And so ultimately you're electing to receive a slightly lower monthly payment in order to protect your spouse if you were to predecease them. Okay. And every situation is different. I've definitely seen cases where even a married couple, they'll elect just the single option. And, ultimately the assumption there is maybe their spouse has a pension as well, or maybe their spouse has substantial assets to self-fund if the result was a premature death on the initial annuitant. So I've seen it both ways, but in this case, for simplicity purposes on the whiteboard, we're going to choose that 50% survivor option. And the payout rate on this one, the payout rate is 7.5% equals the payout rate. Okay. So this is an important number to look at because we're going to look at this 346,000 in a sense of either turning that into a life annuity. In this case, it would pay out about 7.5%, or taking that $346,000 and essentially moving that to an IRA and saying, hey, I'll just take systematic withdrawals out of that IRA during my lifetime. And ultimately, my goal would be to earn a slightly higher rate of return on my own than I would inside of this annuity. Now, one fact that is important is that longevity is on both Jack and Barbara's side. So Barbara's parents are living into their 90s, and so she by default has longevity built into her plan, and we are assuming she and Jack would both live until age 90. The facts and circumstances would be very different if she had, let's say, a pre-existing condition, or maybe she had a diagnosis where she didn't have more than 3, 4, 5 years to live. In that scenario, we'd be looking at this in a totally different lens. But here, we're going to assume longevity to age 90. So just to look at the balance sheet, just on the investment portfolio, so nothing else, no personal assets like their home or their cars, etc. We're just going to look at the financial assets that they're going to be relying on for retirement. So as you can see, they've built up a nice little nest egg of about just under $2.3 million. And the pension, looking at this number here, represents around 15% of the total investable assets amount. Okay, so it's not the majority of the assets, but it's not an insignificant number. And I point that out because this does matter. If this represented the entire investment portfolio for a particular client, might be a little different thinking there, because once you turn this asset into a lifetime income stream, it's not liquid on your balance sheet anymore. You can't tap into it. In the case of an emergency, you only have access to that monthly payment that they would be sending you, okay, which we're going to talk about here in just a minute. But in this option, we're going to do the lump sum. So in scenario one, this is a lump sum option, and we're going to move this $346,000 into Barbara's IRA. Okay, so we're going to do a rollover. No taxes would be due at that point in time, but this $346,000 would then grow tax deferred inside of this IRA. Okay, so this is option one, is the lump sum rollover. You could certainly take a lump sum and cash it out, but that would result in pretty significant tax penalties. So probably don't want to do that unless you really, really needed to tap into some of those funds. And I will say some options, you can do a hybrid. You can roll over some of the pension and you can annuitize some of it. Whereas some pensions I've seen is either all or nothing. You could either turn it into an annuity or roll it over into your own IRA. So it's important to look at your plan documents and understand your plan rules before making a decision. Once that pension hits the IRA, the overall target allocation is going to be what we would consider to be a balanced portfolio. So this is like your classic 60% in equities, 40% in fixed income. Probably one of the most popular, if not the most popular investment option for retirees, because it has a nice balance of equity growth to protect against inflation, as well as fixed income to protect against a downturn like a bear market or a recession. The challenge has been for more than a decade now is fixed income has been such a lagger in the portfolio. From 2009 all the way up to 2020, we had historically low rates for interest rates, and therefore interest payments on bonds have been in the 1 to 2.5% range for a decade plus. And then in 2022, interest rates began to rise, and that ultimately hurt the value of the bonds on the client's balance sheet. So ultimately what we're seeing is, basically a 10, 15-year period where bonds have significantly underperformed their historical rate of return. So that has created a little bit of a drag on a 60-40 portfolio. But on the flip side, equities have performed quite well. And this is really what you're trying to do, is you're trying to hedge your bets. You're not trying to go all in on stocks, because what if stocks go through a prolonged period like 2000 to 2010, where we had two significant recessions, the dot-com bubble bursting and then the Great Recession, versus the fixed income side did quite well from 2000 to 2010. Okay, so the 60-40 portfolio is very popular, and that's what we're going to use in this example, because the clients aren't overly aggressive, but they also recognize that they have longevity on their side and they want to keep pace, if not slightly exceed inflation. This is a great way to do that with the 60-40 portfolio. So what we'll notice here long term, the first number I want us to look at is this income stability ratio, around 50%, which is pretty solid. If this number was 20 to 25%, I may say, you know what, no brainer, let's annuitize this pension. But in this case, even with the lump sum rollover, because of their Social Security payments relative to their expenses, their income is about 50% stable, meaning 50% of their expenses are going to be coming from, in this case, Social Security. So pretty solid. Early on, however, they are going to be tapping into their portfolio a little bit more aggressively because they will be delaying Social Security at least until age 67, which is right here. So as you can see, the rate of withdrawal sort of, it basically averages in that mid fives to maybe high 5% range until dropping down once they begin Social Security. Okay. And then at 75, what you'll notice here, this is age 75. This is when required minimum distributions kick in. So these are RMDs. Okay, so this is a factor because even though they may not need all of that income from those RMDs, they're required to by the IRS code in order to satisfy those RMDs for that particular year. And if those RMDs are not taken out, there's a 25% tax penalty. So obviously you want to follow the schedule for those RMDs, but it could create a little bit of a tax drag in the long-term plan. And one of the things I'm going to reference in this, or I'll link later on in this video, is the Roth conversion window. Okay, so we did a video early on this year to sort of identify this period of time at retirement until RMD age, required minimum distribution age, which for some of you will be 73, many of you will be 75, in which income may be slightly lower, maybe Social Security hasn't begun, and you can begin to do those conversions during that Roth conversion window. So I'll link that video at the end of this one. But you'll see that rate of withdrawal then drops to about 3% during that period, and then slightly kicks up to about 4% once those RMDs begin. Okay. So again, this plan on the surface looks really, really solid to me. Even in this early phase, this gap period, before Social Security, the rate of withdrawal isn't outrageous. Even if it were 6-7% during those years, I wouldn't be super concerned just given their asset size, and ultimately they can bridge that gap until they hit that Social Security payment. Okay, and 50% retirement income stability also checks out pretty well. So let's look at the result of this. Let's kind of look at the ending result from two numbers. Okay, number one, we're going to look at the probability of success. So this is essentially derived from the Monte Carlo. And, the Monte Carlo is essentially 1,000 hypothetical trials for rate of return, because we don't know what types of rate of returns or what types of markets you're going to retire into. Are you going to retire into the markets like from 2012 to 2021? Or are you going to retire into the markets from 2000 to 2010? Very different results from a return standpoint. So the Monte Carlo helps us stress test many different hypotheticals, in this case, 1,000 trials. And ultimately, the probability of success number, this indicates that 92% of the 1,000 trials, no adjustments were made on their lifestyle. So even if the markets crashed, even if we went through another dot-com bust or a great recession or hyperinflation in the 70s and 80s, no adjustments were needed on their financial plan, on their retirement income goals, which is what everyone is trying to accomplish. We don't know what the markets are going to hold, but we want to enjoy our lifestyle. We want to sustain a certain lifestyle, sustain some financial independence, and not having to work anymore. Okay, so in this case, 92% is a very, very solid plan, and as a result of that, you can look their investment portfolio. It started at 2.3 million, and they actually grew their portfolio just a little bit. Now, this does not factor in inflation. So these are future dollars. So at age 90, 2.6 million will mean fewer dollars in today's dollars. Okay, so it'll have less purchasing power with 2.6 million at her age 90, but still the end result is essentially they preserved their principal and grew it slightly, maybe about 10%. They grew it slightly, not adjusted for inflation. That to me is a win. Most people would love to preserve their principal while still doing what they want when they want to do it. Okay, but so this is the lump sum option. Looks pretty good on paper to me, right? But now let's look at the other one. Let's say, okay, you know what? Let's look at the balance sheet. And instead of taking that pension and rolling it into the IRA, now we're going to turn this into a life annuity, okay? We're going to call this the annuity option. Essentially, this is the pension option. Okay, so we mentioned that 7.5% payout rate. So instead of that asset on the balance sheet, it's going to result in approximately $26,000 per year as a life annuity. And now this will adjust for inflation as well. And that is a consideration when you are deciding on whether or not to annuitize versus do a lump sum rollover. If the pension does not adjust for inflation, it better be a significantly high payout rate. It better be 8.5%, 9.5% in today's markets. I'm recording this in 2025 versus one that does adjust for inflation. You can live with a slightly lower starting point, knowing that that's going to keep pace with inflation over time. In this case, that is the assumption built in, is that that payment will continue to increase over time. So almost looking at this like another Social Security payment. So now they have Jack's Social Security, and then they have Barbara's Social Security, and they have this life pension. Now the downside is, right off the jump, is that this money is no longer liquid on the balance sheet. So as a result, the starting point from an investment portfolio is now $346,000 less. So if both of them unexpectedly passed away in day one, as we already talked about, if Barbara were to pass away, 50% will continue for Jack. But if both of them were to pass away, no money would be left over to any children or grandchildren, etc. So that is a consideration. That is a downside of turning this into a life income. And let's assume the same scenario, that the remaining investments are going to be this 60-40 portfolio, 60% stocks, 40% in fixed income, to keep things apples to apples. And let's look at the rate of withdrawal first of all, and let's look at the retirement income stability ratio. Number one, as you can see here, the retirement income stability ratio jumped by about 16%. This is substantial. Now we're in the 65% range of their expenses in retirement are going to be coming from guaranteed income sources like Social Security, and now with the pension. Additionally, what you'll notice is that the rate of withdrawal starts off at a much lower rate. This may not seem like a huge amount, but instead of the mid to high 5%, now we're at roughly 5% on an annual basis during the gap period, the gap until they begin Social Security. And then during the Social Security period and pre-RMDs, now we're sub 2% rate of withdrawal. So essentially the exchange is taking this asset, instead of it being on your balance sheet liquid that you're investing, now you're turning it into an income source, and the remaining assets you're relying on a little bit less. And let's look at the impact over the duration of this retirement period. The first thing you'll notice, the probability of success jumps to 100%. So in this scenario, there was never a trial in the 1,000 hypotheticals. So I was looking at extremely bad scenarios and then extremely optimistic scenarios. There was not one where Jack and Barbara needed to adjust their lifestyle a bit. Think about the peace of mind that might provide somebody that is approaching retirement. They don't know what they don't know. We don't know what the markets are going to look like over the next 25 to 30 years. If I could tell them, hey, Jack and Barbara, we've stress tested all the potential hypotheticals. There was never one scenario in this particular plan where you needed to adjust your lifestyle at all. In addition to that, not only is your investment portfolio still intact, remember it started at about 1.9 million, now you're leaving about $3.3 million. This number comes from the median trial, by the way. So it's essentially the 500th trial. This is the amount that was left over at their age 90. So not only did they keep their portfolio intact, but they also grew their portfolio even in excess of what it was had they chosen the lump sum rollover option. This is why this topic is so important to think through, is because many people have this assumption that if I roll it over into my IRA, I'm going to be able to invest the money, have more control, and as a result, leave a larger legacy to my children or grandchildren. And that might be true if you pass away early. But if you pass away, let's say at your life expectancy or even beyond potentially your life expectancy, that lifetime rate of withdrawal, that retirement income stability ratio matters so much. And ultimately, electing the pension option, electing the annuity option, even though you're starting with a lower dollar amount up front, it results in a higher amount that's left over at your death, which is very counterintuitive to the way a lot of people think. And it's not insignificant. We're talking about 2.6 million versus 3.3 million. We're talking $700,000 of future dollars left over at the end for your children, for your grandchildren. Think about the impact that could make. So again, the pension option, it's not just for you, it's also potentially for the next generation or multiple generations to come. One thing I talk about on the podcast and also on the whiteboards quite a bit is this idea of risk capacity. Risk capacity is different than risk tolerance. Risk tolerance is how do you feel when the markets go up and down, whereas risk capacity is are you able to take on more risk or are you able to take on less risk based on a decision that you can make? Okay. And so in this scenario, because they elected the pension option and because that retirement income stability ratio is so high at 65%, and because the Monte Carlo now checks out at 100%, okay, and this is one of the things I talked about in last week's podcast, where if you're overfunded for retirement, what are those levers you can pull? What are those 6 levers you can pull? So I will link that as well. I'll link that podcast, which is embedded into YouTube. So I'll link that one at the end. But ultimately, one of the ideas is they have the ability, Jack and Barbara, to take on as much or as little risk as they want, given this fact here that they are overfunded. They are ahead of the game. They're 100% funded with their Monte Carlo. So let's hypothetically say, you know what, they have the risk tolerance, and now they also have the capacity to actually increase the amount of risk that they're taking. And when I say increasing risk, what I simply mean is increasing their equity exposure and reducing their fixed income exposure, okay? Because ultimately, if you really think about it, that pension that is paying them on a monthly basis, that is essentially like a bond. It's a bond that's going to pay you as long as you live. So why not allocate that as part of the balance sheet? Even though it's not liquid anymore, it's spinning off retirement income. So ultimately, they have the capacity to increase their remaining equity exposure to essentially earn a higher rate of return than what they would have had with that traditional 60-40 approach. So let's say hypothetically, they moved one notch up. They moved to what we call moderately aggressive, which is, we'll call it 72% in equities and then 28% fixed income. So they reduce the fixed income exposure, increase the remaining equity exposure. Now look what it does. It does not change the Monte Carlo. We're still 100%. That's one thing to check, is if they do dial up risk, there could be a scenario where, hey, if the markets don't behave, maybe they do need to make an adjustment in certain scenarios. In this case, just dialing it up one notch did not impact the Monte Carlo one bit, but it positively impacts that 500th trial, that median trial, by way of 3.9 million that would be left to the next generation, would be left to their heirs, as opposed to 2.6 million, assuming the lump sum option, and then 3.3 million for the option of annuitizing or turning that into a pension, but staying balanced, staying 60-40. In this case, we're now mixing this idea of risk capacity with this retirement income stability ratio, and ultimately showing you the impact on not only their retirement and their peace of mind that, hey, there's never a scenario where they ever had to make any adjustments, but also the impact that they can have in terms of leftover dollars at the end of their life, if that is important to you. So just some final thoughts on this one. If they followed kind of the mainstream advice, I really would call that the mainstream advice, which is rolling over those dollars into their own IRA because they can potentially earn a higher rate of return. That could be potentially true. However, if longevity is on their side, if longevity is a factor, it might be difficult for that scenario to beat the pension option, to beat that option of a 7.5% payout rate. Because again, you think about rate of withdrawal. We think about the famous 4% rule. That's on average what a lot of times I see DIY investors withdrawing from the portfolio, 4, maybe 4.5, maybe 5% a year. Where in this case, we're unlocking 7.5% that they're forcing you to take out of that portfolio, which is very, very difficult to do on your own. And as a result of that, you're maximizing that income stream from that particular asset and also protecting against longevity. Now, certainly there is a risk. If you pass away early, if both of you passed away, before life expectancy or unexpectedly right away, which is certainly a possibility, certainly you were better off rolling that pension into an IRA, because now that IRA would be passed on to the next generation, to your beneficiaries. Okay. So certainly it would provide a little bit more liquidity. But if they move forward with the pension option, counterintuitively, because it reduces that rate of withdrawal, because it increases that retirement income stability ratio, but because it increases their risk capacity, their ability to actually take on more risk with the remaining assets, it can not only improve their probability of success in their retirement income goals, but also could improve the amount of money that is left over at the end in terms of legacy. Again, very, very counterintuitive to what most people think of when they think of annuities or pensions, etc. But what I'll say is just a quick final thought. There's no right or wrong answer on this one, okay? The key is to figure out and discuss what is important to you, what is important to your spouse, what is going to give you all not only the most impact from a financial perspective, but also psychologically. That peace of mind is huge in retirement. You don't want to be worrying about every single news story that's impacting the markets on a day-to-day while you're vacationing overseas in Europe or spending time with your grandkids. Okay. So you need to think through not only the quantitative, but also the qualitative factors in this decision making. But I hope you all found this helpful. If you did find it helpful, make sure to like the video. That really helps. Or comment. What are you planning to do? If you have a pension, are you going to roll it over to an IRA? Are you going to annuitize it? Are you going to do a combination of the two? Okay, would love to hear from you. And again, I'm going to link the videos on Roth conversion windows. And I'm also going to link the recent podcast, which is 6 levers to pull if you are overfunded for retirement. And what I will say, if you're looking for help on this one, I would highly recommend going with an advisor that is not charging you an assets under management fee, because they're not going to give you objective advice. That is not selling commission-based products, because they're not going to give you objective advice. They're going to be very subjective based on the financial products that they sell. I'd highly recommend seeking out an advice-only planner or a planner that charges flat fees. Very, very important when you're making these pension decisions, so you can get objective advice. And if you liked this video and you are planning for retirement, you're over 50, make sure to subscribe to our YouTube channel. We put out weekly retirement-related content specifically curated for you, and also make sure to subscribe to our podcast as well. And if you're interested in learning more about what it would be like to work with our firm one-on-one, I'll drop a link in the comments section in the description about a little bit more about our firm and how you can get in touch with us. That's it for today, everybody. I'll see you next week.